Yeah. So cash flow projection from fundamentals to forecasting, right? So the idea behind this webinar is I hear people reach out to me and say, oh, that they want to know how to create a cash flow projection, right? And what exactly entails. So we want to create something that talks about end to end of what it entails. And we've designed a template which we shared previously. And we also have a use of how the template works online. But I think this webinar brings a blend of multiple things on board. One is that it helps one first understand the theory behind cash flow projection. Why do we even do it? What is required? What is the advantage of preparing it? And all that fundamentals. And what exactly is the knowledge or skill required to prepare a cash flow projection? And how does it benefit us? And how do we use such? Yeah. But generally, what I generally just tell people first is we generally have class rules. One is use your name on Zoom because that way we're able to interact properly. Everyone contributes in the sense that if you have the opportunity and you have questions, you can always drop it because we learn from one another, right? No one is an island of knowledge. And by the mere fact they're able to contribute makes the webinar very interesting and very engaging. I muted everybody such that we don't have interruption during the course of the webinar. But if you have a question, you can either drop a message in the chat box or you just signify by raise of your hands, right? We'll have designated points during the course of the webinar where we'll allow people to ask questions. I will answer them. But please note that questions being asked during the webinar will be focused around the webinar itself, right? So we'd expect that questions outside of what we are covering in the webinar is what we'll focus on, right? So please bear that in mind. And otherwise, we'll not be able to answer such questions. Such questions will be treated outside the webinar. Now, who are we? I'm sure a lot of you are joining us for the first time. So for us, we have a vision. Our vision is to become the #1 practical accounting school globally, possibly impacting the lives and careers of over 2 million accountants. Right now, we're not where we want to be, but what we're having as a webinar today is one of the steps in the right direction to impacting the lives that we want to hit that huge milestone. So bearing that in mind, right, what we do, how do we intend impacting the lives of over 2 million accountants? One is sharing materials and content on social media. So if you follow us either on Instagram, Facebook, LinkedIn, Twitter, YouTube, you see that we share content, right, at little or no cost, such that as an accountant, if you need to improve your career, just by following us, you're able to improve your knowledge from a very practical standpoint. Now, the space in which we play in is practical accounting. So at the moment, we don't take like trainings on ICANN or ACC classes. We focus on practical accounting, meaning that you are working a 9 to 5 and you need that knowledge to help you navigate your work environment. Where do you need to be to? Is accounting yard, right? Now we do that again. We also do that by organizing very affordable trainings to participants or people who are interested in building their practical knowledge around accounting, right? So just for example, we're about to conclude our current training on financial modeling. We've done other trainings in the past. We concluded creation of financial statements. We have a course on tax. We have a course on preparation of management accounts. We have a course on basically keeping incomplete record. We have a course on Excel for accountant, and many more, so many other trainings, right? So right now, we have close to 15 different practical courses for accountants where you can build your knowledge on practical accounting. Yeah. Now, this is currently our training calendar. Like I said, we're just about concluding our financial modeling, ending on the 26th, right? And by 2nd of August, we'll start our Excel for accountants. So if you are someone looking to build knowledge around Excel for accountants, you can join our training around that period, right? The management account and budgeting and tax practice, and they all flow towards the end of the year. So if for any reason you're thinking about building your knowledge on practical accounting along this line, you are more than free and to reach out to us, and definitely we'll be able to share that with you. Yeah. Now, I'm your host. My name is Oladile. I'm an accountant like you, right? I basically consider myself a teacher. Like in my current space right now, I'm basically teaching. If you are familiar with the YouTube channel, you'd have heard my voice on different occasions because typically I kind of record video sessions on practical accounting. I have over a decade experience from finance, accounting, and audit, right? In my former life, I was an auditor, right? But right now, I'm more into accounting, core accounting, and even audit itself. I think the internet is saying unstable. Let's see. Okay, you can hear me now. Okay. So I don't know, someone is just trying to write on my screen just to be sure that nobody's messing with the screen. Yeah, I'm not sure that no one is messing with the screen. Okay, so no one is messing with my screen. Let me go back to full screen. Okay, so currently I'm head of finance of one of the largest agri-tech businesses in Nigeria. I'm also someone into planning and analysis, right? So you're thinking about building financial models. I have knowledge in that space. Currently facilitating the training on financial modeling. So some people call me AK Mr. Right, some people call me Prof. Those are AKs I come by. Now, so at this point, I'll pause and take expectation of people who have joined the webinar, right? So there are different walks of lives of people in the accounting space. So when they were coming and they heard about the webinar, what was the expectation, right? So the reason why I say this is that sometimes people come with different expectation. So it's important we iron out what the expectation is so that we know at the very beginning what we hope to achieve from this webinar. So if you have your expectation, you can either drop in the chat box or you can signal by raise of your hand and I'll mute you to hear you verbally say what your expectation is about the webinar in the first place. Yeah. So people are saying they can't hear me. Just to be sure. Okay. Hi, doctor.
Yeah. Good evening, sirs.
Yeah, good evening. Can
Yeah.
you hear?
My major expectation from this webinar is to increase my knowledge in the preparation of cash flow. So just for improvement, yeah. Thank you.
All right. So yeah, so you have spoken. Now, and I'm going to respond to some of these things. So let's just go through and let's see. So rest assured, if you don't have the template, doesn't mean you not get it. So once the webinar is over, once the webinar is over, by tomorrow, the video would have been uploaded to YouTube along with the template itself, right? And so that if you just go to the YouTube channel, you can easily download the what's called it, the template and also the document used for this particular webinar. So you have a blend of both. Yeah. Okay, so someone is saying to have a broader knowledge of cash preparation in my profession, my students to know how to use Excel and increase my knowledge in FS preparation and cash flow projection. My vision is to improve my competence in cash flow projection and forecast preparation. My major experience is to learn how to forecast my business growth financially. Cash flow projection and forecasts to be able to prepare a better cash flow, to be able to prepare cash flow projection. Someone is saying, I've missed all the trainings. You can always chat accounting yard number and we would share that with you, right? So we don't plan to hold more trainings we miss. We don't have plans of whether repeating them, right? They've been Excel, but the recordings are available. You can get that for an affordable price. Yeah, I think I've shared the YouTube link. Let me share it again just so that in case anybody sees it. So you can, just by following the YouTube channel, once it's uploaded, you will get the notification. Yeah. Okay, so I guess from the chat I'm seeing, people's expectation for the webinar is kind of aligned. I don't see any hands up, right? So I don't see anybody that wants to verbally express himself in terms of expectation. But if anybody is interested in expressing himself, I'm more than happy to unmute the person to hear his own expectation from the webinar. Yeah. Okay. All right. You can unmute yourself, Isiaka.
Hi everyone, good evening. Hope you can hear me.
Yeah, sure, I can hear you.
All right then. So basically, my expectation is just to be able to understand the cash flow projection in a very detailed way because I recently prepared one and I had to submit it to Access Bank for a particular facility for the company. So initially I did a a very straightforward method, just did and submitted to the bank, but then they returned it and made some corrections here and there and told me to do something. So I had to now redo it the proper way, but still, I didn't get the proper overview of the whole thing. So that's the one of my expectation here to get the core basic of how it works.
Okay, all right. So Isaka, I'll respond to that now, right? Now, because it's a webinar, there's a limit to how much detail we can get into, right? But what I want to, during the course of the webinar, I will explain some key things the banks pay attention to, right? In terms of how they think about cash flow projection. And me and you can always engage for that, right? And I can explain in more details things that potentially we may not be able to cover during the course of the webinar. Now, I'll be very realistic with you, right? And which is what I'll talk about during the course of the webinar. There are levels to these cash flow projections, right? And the higher you go, the more complex it could potentially be, right? So one can think of it from the perspective of a financial model. Or let me not go to this. You will see how I'll address some of those things as we get across during the course of the webinar. Hi, Paul. Hello, Paul.
Yeah,
Yeah, me too. Paul, you're muted again, but I'm trying to unmute you just to give you a opportunity to speak. Hello? Hi, Paul. You're muted if you're trying to speak. Hello, Paul.
all right, can you hear me now?
Yeah, sure, I
Yeah,
can
I
hear
can
you.
hear you. Yeah. I mean, what I intend to learn more is this about the cash projection, and again to be able to stand alone as a manager to manage every aspect of accounting process. What I know with this, my knowledge is more broadened, and I just want to be independently, and to do it myself. Thank you.
All right, welcome. Hi, Ifoma. Hello, Ifoma.
Hi, good afternoon. Can
Yeah,
you hear me?
yeah, sure, I can hear
Okay.
you.
Yeah. My expectation is to use cash flow for decision making, management decision making process.
Okay.
Thank you. Yes.
Okay. All right. So I've seen some other expectations, and I would, so you bear with me, we need to get into the actual work itself. So the first thing I'll tell you is that what are we going to talk about? Introduction. That basically just introduces what cash flow projection is. The why. Why do you even prepare a cash flow projection? The ingredients. What are the things you need to prepare a cash flow projection? Then the third one is the model itself. So what kind of models exist for cash flow projection? What kind of Excel knowledge do you need to be able to walk through a cash flow projection? Then the practical application, which is basically a walkthrough of an existing model and seeing how key attributes are fed into the model and how it now flows into the cash flow projection itself. Yeah. Now, the why. They say revenue is vanity, profit is sanity, but cash is king. Now, the reality is that for a business to continue to run, right, to continue to be in existence, there's the very important for the ability to manage liquidity, right? And people pay attention to it because it plays a very vital role. Because when there's cash flow, there's an ability for the business to continue to sustain, even when you're making losses, right? Once there's cash, you can still continue operating. But you know that if you're making profits and you don't have cash, there's that probability they will not be able to operate anymore, right? So there's that need to ensure that you're able to manage the cash flow of a business. And this is what this template helps you address and in terms of how you think about it. Now, they say many profitable businesses go bankrupt. Why? Because they run out of cash. Profit on paper does not pay salaries, suppliers or tax authorities. Now, cash does. Now, you ask yourself, if your employer is not paying your salary, will you continue working for him? the question most often than not is that you consider that maybe I should consider getting another job because if it doesn't pay my salary, how will I come to the office to work? So it's very important that as much as possible, that what the business is able to manage its cash flow. Now, a cash flow projection is in your company, is your company's GPS, right? If you understand what GPS is, imagine how you get to a new location and you don't know how to move around, right? You see how you use Google Maps to be able to trace and go around wherever you're going to. That's what cash flow projection is. You'll be able to tell a business there's a problem coming forward in the near future, or oh, there's an issue that we need to address early enough. Otherwise, if you're not careful, 3 months, 4 months down the line, we'll get into a problem, right? So it does basically help you navigate financial bumps in the road before they hit them. Because that way, it helps you identify a problem before the problem becomes something that you cannot do without, right? Just look at it from a perspective of an early warning system, right? An early warning system is in the sense that it warns the owners of the business or the managers of that business that there's a likely problem in front and you need to act quickly before you get into that issue. Yeah. Now, what are the use cases for cash flow projection? One is managed liquidity. That one is pretty straightforward. As your day-to-day operations, you will see that some businesses will tell you that on a Monday morning, the first report the CFO wants to see is a cash flow projection for the next 3 weeks, cash flow for the next 1 month, for the next 6 months, right? Because they want to know where are we with cash and how are things before we get into problem. The other one is securing financing. The financial institutions are very interested in your cash flow projection because at the end of the day, it's your cash flow that will repay a loan. So they want to be able to see the facility you are getting, how we use it to generate cash, and how we use it to pay or service that particular facility so that you will not go into default. And that's why they are very interested in seeing cash flow. CapEx. We know very well that CapEx, which is capital expenditure, is usually very cash sensitive in the sense that you spend a lot of money to be able to invest in CapEx. You want to buy equipment, you want to buy a property, it's usually very huge. And if you don't plan for that cash need, it could either just turn your business upside down or disrupt operations. So whenever there's a CapEx need, you need to plan. I'm not talking about buying a laptop. No, I'm talking about CapEx, proper CapEx, right? I need to properly do what? Plan for it. Now, what do I mean by this? If you pick your CapEx, you will notice that for some well-structured businesses, you will see that they usually require for board level approval for CapEx. One of the major reasons why that happens is because they know in very sound detail that CapEx could impact the cash flow of the business. And that's why typically you see that for most very structured businesses, investment in CapEx, they usually approve a CapEx plan for the year. So that before you even think of spending it, they've approved it so that they already know that, oh, from a liquidity standpoint. And in some business, you see that when you want to finance CapEx, you may need some level of borrowing to finance it. If you not finance it from your operating activity cash flow, what do you need to do? You need to plan how you need to secure that funding to finance it. So it's very important. Business valuation. The most very popular form of valuation is what we call DCF, discounted cash flow. What is it telling you? It's cash flow again. And what is that telling you? That is basically saying that as a business, how will you generate cash in the next 4, 5, 6 years and discount it to what? Present value. And that's what you determine the worth of that business. Because at the end of the day, when someone is buying a business, you want to see how much cash business can generate from him and how that translates to the value of the business. So, very important. In scenario planning, as you think about the business and they're planning various scenarios, right? You want to see, oh, from us going this route in our decision making, how does it impact the business, right? So you want to see cash flow projection can help you see the scenarios or various outcomes, right? In terms of if I decide to give a discount to a customer, or I decide to buy a particular CapEx, or I decide to delay purchase of a particular CapEx, cash flow projection will tell you how does it impact the business, and you can plan scenarios around those use cases. Yeah. So these are popular use cases. It's not exhaustive, but at least for most often or not, when you think about liquidity planning or cash flow projection use cases, these 5 come top when you think about use cases for what? Cash flow projection. Now, when you look at the cash flow projections, you basically have majorly 2 components. You have the cash inflow and you have the cash outflow. The cash inflow talks about how things will come in that will result into cash flowing into the business. Typically, this will come from either your sales forecast, so how the business intends to sell, right? And how those sales will translate into cash and come to the business. The other one is your account receivable aging, right? So most often than not, for businesses that sell on credit, they usually have receivables from various customers. Those customers have a timing of when those cash flows will come in. So your agent will tell you, oh, this cash will come in 1 week, 2 weeks, 3 weeks from now, or 1 month from now, or 6 months from now, based on your credit term agreed with the particular customer. So typically, you want to be able to translate that your aging analysis into the expected timing of when the cash flow will come in. The third one is your loan schedule. So typically, your loans will typically have a disbursement date. So if you're taking a new loan facility, in your cash inflow, you want to plan the inflow of when that cash will come in into your business. Then from the cash outflow perspective, you talk about your account payable, which is the opposite side of your account receivable. When you take or you purchase items, either inventory items or services or whatever thing that you've had your vendors deal with you, you have payment terms you've agreed with that vendor, and when that was cash outflow will go out, right? You've agreed payment terms with them. So the cash outflow that would happen as a result of the contract you've entered with your vendor, you want to plan it based on the aging. You have payroll data. Me and you agree that salary accounts for a huge portion of your cash outflow, kind of, right? Every month, a business will pay its staff salaries. So as much as possible, when you're thinking about your cash outflow, you're thinking about what? Your payroll. Now, you have operating expense. So you have things you pay for general operations of your business that may not be payroll related, but also expense. It could be consultants, right? Fees. It could be transport. It could be repairs and maintenance. It could be different things. You just need to look at, have a good understanding of the business you're dealing with, and what are those things that typically lead to cash outflow. So you can use that to project and analyze and say, oh, these are the expected things that come to cash flow. They have CapEx, like I said. You know what the plan of the business is in terms of when they intend to acquire capital expenditure. They want to acquire a new plant and machinery. They want to acquire a land in a new location. They want to buy a building in one location. They want to buy a new truck for transportation. All those things are CapEx in nature, and they're quite huge. You want to be able to what? Plan their cash outflow, and they'll form into for your cash outflow. You have your loan amortization schedule. Now, we talked about your loan from the inflow perspective, which is when the principal disbursement. But from your cash outflow, you talk about principal repayment and interest repayment, right? Those form part of your cash outflows. Now, tax payments, either VAT, withholding tax, CIT or ET, right? Relevant tax, they could also have huge tax or cash outflow. You want to plan for them. Yeah? Just imagine, for most businesses, when you're paying CIT or ET, you see that usually the cash that goes out during that period could be very huge. Yeah? So you want to plan it. Otherwise, if you don't plan for when that cash is going to come out, when it's time to pay, you just realize it's going to disrupt the entire operation of the business. Now, to be very honest, in understanding these two components, you need to understand the business you're dealing with very well. And you need to also understand what exactly is needed. And again, you also need to know how to gather those data. And it's important to know that there are key departments you need to understand how to interact with them. Yeah? So, for example, you have interactions around you're dealing with your procurement team, because they have a good understanding of the current procurement that will happen. Your sales team, they have a good understanding of what they've agreed with the customers and how the buying pattern could be. Sometimes you think that you have to have a probing mind, because your sales teams could be quite aggressive, and you have to balance being optimistic and being a realistic person, right? Because the reality is that when you're in your cash flow projection, you want to be very careful not to be very aggressive, but playing around that devil advocate where you're playing a very safe point. Because you know that historically, you sold, for example, 20,000 units of a particular product. Sales is telling you that they can do 40,000 units. But you need to understand how they want to achieve that 40,000 units. Right? So you have to strike a balance between sales is saying they'll do 40,000 units, and you know historically your monthly average is 20,000 units, which is double. So understand how they arrive at 40,000, and understand why you need to either play between 20 and 40,000 and draw scenarios around it, how it impacts the business, right? Because automatically, if that particular forecasted sale does not happen, it could impact a lot of other things. So please, you have to play the devil's advocate. And similarly, payment, you want to be very aggressive with it. Any payment that is due, don't say, oh, we know the vendor. Put it as when it should flow, exactly when you should repay that vendor, right? If the vendor decides not to come in, you know that you planned for him and you're not going to be in default, right? Then say, no, the vendor, we've agreed with him that we can push the payment. No, you try to put it to when it's due. If it doesn't come, it pays you. But if it comes, you know that, oh, you already planned for it as much as possible. So it's important to understand these components and know how to leverage them and how to source data that are credible and reliable, because your data sources is very important as you build a cash flow projection. If you get the data wrong, your cash flow projection would also have a problem. Now, in building a cash flow projection, you need to understand choosing the appropriate model and choosing the right horizon. So basically, I divide cash flow projection into 3 types. One is the simple model, very simple, single tab, quick to build, easy to understand, lack detail, not dynamic, right? But it's prone to error. But it's very good for small businesses and the back of the envelope checks, right? So that means this one, you don't put a lot of detail, a lot of numbers are hard-coded, it's not dynamic, it's easy to do and just put and you go off. The medium tier, this one has some element of assumption and some element of structure. What you see is, you see some assumptions, you see a calculation, and you see a summary, right? You see balance and the detail, and there's some element of visibility. Now, you can use it for scenarios, and they're best for most operating companies, right? So meaning that it provides some level of granularity in the data required and has some element of flexibility. The last one is a complex model. And I don't know what Siri or Isiaka, right? Now, the one you typically deal with a bank may most likely fall within the complex model scenario, right? But I know Nigerian banks, you can still do without doing this, and you can fall in your medium tier scenario space, right? But the complex model, when you're dealing with very advanced institutions, they want to see your primary 3 statements and want to see how it converts into your cash flow statement. And typically, more often than not, when we talk about cash flow from this perspective, we're referring to the direct method of cash flow, not the indirect. More often than not, when we think about cash flow projection, when we think about what we're liaising with bank, more often than not, what they're very interested in is the direct method of cash flow, which you will see in the projections that I will show you. Now, time horizon. Now, what do we mean exactly by time horizon? Now, when you build a cash flow projection, you will see some cash flow projections that are weekly. Now, that is typically for the ones you build internally for management reporting, and you want to track it. You want to be very careful. You see it week, right? Sometimes you see up to 8 weeks, 12 weeks. You see some people 6 weeks, but it's on a weekly basis. It's very granular because you're tracking it on a weekly basis, right? Because you want to be able to show that there's no problem and you can pick up an issue very early enough. So it's quite detailed. Yeah. Now you have the other one that I call a monthly forecast, right? So this one is for operational planning. You could see 12 to 18 months ahead, most versatile for business management. You see that? Yeah. Now you could see it's quarterly and an annual forecast, right? For more often than not, the ones you see for dealing with liaison with bank, it will be a function of the structure of the facility. So if the facility you are servicing every month in interest payments, you want to do a monthly version. Good enough. We don't have facilities that we pay to banks on a weekly basis, right? More often than not, it's typically monthly repayments, quarterly repayments, biannual or annual, right? So typically, the monthly cash flow should be fine. But the key thing you also notice that if you are doing a cash flow for a financial institution, which is related to a facility, at a minimum, the total length of that facility must be equal to the tenure of that facility, right? So you cannot do a cash flow projection that will cover 2 years and you're going to approach a bank for a facility of 5 years. It is not. They will reject it from the word get-go. So the length or duration of the facility and the length of the projection must marry each other at a minimum, right? Because for them, the critical thing they are checking is that cash flow projection must do what? Must be able to repay or service the loan in question. So at the minimum, it must balance that. Now, I'll pause here and take questions because I know I've said a lot, but so that people can ask questions at this point in time. Hi, doctor.
Yes, sir. Well done, sir. Under the component of cash flow projection, I could see that purchases was omitted, and we slated sales forecast, but purchases forecast was not stated. It only stated account receivables. There are some that can be bought with cash, raw cash, without owing the vendor. That's my
Yeah.
observation, sir.
Okay, doctor, thanks for pointing that out. I think I did not state it there, but a very valid point you've raised. So similar to how we talked about sales forecast and account receivable, from the outflow point of view, we could also have a line called purchases. Purchasing in terms of that there are things you want to procure, inventory items and other items that are very important and you want to have them. So it's very valid point you've raised there. And I agree with you 100%, 120%.
Thank you.
All right. Hello.
Hello, well done, sir.
Yeah, well done.
My question is, for example, your CEO call you and ask you to prepare a liquidity forecast. Is it any different from cash flow projection?
So you're saying your MD calls you to prepare a liquidity what?
Forecast.
So to the best of my knowledge, they are very similar, right? Because then they are both answering the same question in terms of where will we be from a liquidity standpoint? Where will we be from a cash flow standpoint? So to the best of my knowledge, they are the same, right? It's just a use of terminology between both parties. If I find myself when he asks that kind of scenario, if I don't mind, I ask him, okay, what's the expectation in terms of what he wants to see so that we are clear? Do you understand? So that way, I understand there's no gap in terms of expectation. But on face value, what he's asking for is the same thing.
Okay, sir. Thank you.
All right, no fine. Hello, Ghanaian.
Hello?
Yeah, hello, I'm with you.
Can you hear me?
Loud and clear.
Okay. While you are talking about this projection, you are mentioning the right method of preparation. I want to ask if we are not mixing it up with cash flow statement, because you know cash flow statement has direct and indirect method. Up is not, although I have not seen the template you want to use for it. I just want a clarification on that.
Okay, so that's why I said it clearly that it's a direct. When I say direct method, in the sense that if you look at it, it's similar to how you look at how your direct cash flow statement will look like. The only difference is that in this particular one, you know, when in your cash flow statement you have investing and financing activity. In this particular one, you not see investment and financing activity. They would either fall into two buckets. It's either things that wake up your cash inflows or things that make up your cash outflow. Right? But if you look at the attribute of the figures you are looking at, in terms of what you see, they are very similar to what you see in your direct method of cash flow preparation. Right? So, for example, collection from customers is what you see in your direct cash flow. But in indirect, what you see is net income and seeing some adjustment to it. And that's what I'm just trying to bring into that perspective, that what you see is close to what you see in your direct cash flow. Does that answer your question?
Yes. It's okay.
Okay.
Thank you.
Okay. So Jibola is saying, can I take time to explain the time selection again? Okay, no problem. So I'm saying that basically you could prepare your cash flow projection on a weekly basis. You could prepare it on a monthly basis, and you could prepare it quarterly or an annual basis. I'm saying when you think about it from a weekly basis, it's really usually for when you are trying to do a very tight liquidity planning, because every week you want to account for your cash, right? So typically, this is usually very robust case when you know that there's an issue with cash flow and you want to monitor the cash flow very closely. In businesses that are very cash sensitive, you see them use your weekly cash flow forecast. It is very granular and very detailed, and you're monitoring your cash flow. Your monthly is not as granular because basically you are saying that anything that will happen between week 1 to week 4, you're not bothered about which week it happens. It's in that month it happens, right? And that's how your monthly looks like. But you see that the length of time you see for that one is really way longer, right? Unlike your weekly, you see 8 to 12 weeks is maximum of what? 4 divided by 12, that's like 3 months, right? But when you're looking at monthly, you typically will do for a longer period. Yeah. And usually used for operational planning and just seeing how things are working. But when you're thinking about a facility with a bank, for example, like I said, whatever cash flow projection you're doing, the length of the period, it could be monthly, it could be quarterly, right? But on the long run, whatever period you are seeing, the total number of period, the length, must be equal to the tenure of that facility itself. Then typically the frequency will be a function of the frequency of repayment. So for example, if I'm servicing a loan every month, it means that whatever cash flow projection I'm doing, I must be able to show it on what? On a monthly basis. If I'm servicing the loan on a quarterly basis, at a minimum, the cash flow projection should be on a quarterly basis. Do you get? If I'm servicing the loan annually, at a minimum, the loan must be annual, right? And that's how it works, right? So that is the idea behind how we think about the time horizon selection, based on the need case, as the case may be. I'm new to cash flow. Is it the cash, the physical cash? Oh, so in a particular scenario, right, it could be both physical cash in terms of cash in your petty cash, right? It could also include your cash at bank. But more often than not, we both know that for most organizations, your physical cash will be very small. So in terms of the implication for a cash flow projection standpoint, the likelihood that your physical cash will have a huge implication on your cash flow is very minimal, right? I know there are instances, there are some businesses that are very cash driven, that if you see how much they collect physically cash on ground, it could be a lot. But at the end of the day, I think for most standard businesses, if you have huge cash collection, you typically will do what? Will most likely deposit it at the end of every day, right? So that working with it may not necessarily be necessary. So we're looking at the total cash of the business. It could be cash at bank, cash at hand, cash in fixed deposit, right? It could be anything that you can consider to be fall into the definition of cash and cash equivalent. It falls into it, right? And the reason I mentioned this piece is that cash, it plays a role in your cash flow projection, because it's a place where you need that your total cash that's available as what the opening balance in your cash flow projection, right? Then cash again also refers to your payments in terms of how your customers are paying that will come in cash inflow. If your customers are paying you cash, they pay you cash, like physical cash. It's part of it, right? But we're looking at it holistically, not just physical cash, but also electronic cash already in your bank account and all that. Is there a need for a facilitator to differentiate between the projection of cash flow and projection of cash flow? So right now, the projection of cash flows. Now, I believe you are referring to the cash flows that we typically see in our management accounts and our cash flow that we see in our financial statement. Now, this particular one is one critical thing we need to pay close attention to. Is the one we prepare in our manual accounts or our financial statement is what? Historical, right? In the sense that those events have occurred and it's based on historical data. The cash flow projection we're referring to is more looking into what? The future, right? So it's meant for decision making, looking into the future. And that's the one major difference between the two. The cash flow used in preparation in your operation of either your money account or your financial statement is in line with IFRS, right? There's a standard that backs it in terms of how you need to prepare it. This one is not there's no standard guiding it. It's more of best practice of how people think about how they look at it, what makes up cash flows, what makes up what falls within your inflows, and what makes up all your cash flow, right? So there's a generally accepted kind of, if there's no way documented that this is how you must do it, but generally people already know that anything that meets the definition of cash inflow should fall into your cash inflow section, and everything that meets your definition of cash outflow should fall into your cash outflow section. So it's just on that basis, clearly differentiates between the two. So someone say, what is the difference between cash flow forecast and budget? Now, budget is a very larger term, right? Because in your budget, you could have your income statement, your financial plan, all, right? Cash flow is one thing, focus on cash. Yeah. So you could have within your budget a cash flow projection in between as part of the component, right? But when I say cash flow projection, it's strictly your focus on the cash flow projection, right? But there are instances where you build a primary tree statement by virtue of the complexity of the cash flow projection, because you want to see that correlation between your income statement and your statement of financial position and your cash flow projection, because there's some interplay on how they all work together. So you want to be able to show that reflection, but they're not the same thing. Do you consider our investment in securities when preparing cash flow projection? So yes, I think you can consider your investments if those investments are highly liquid. So for example, I have an investment in money markets. I know that if I wake up today, I can liquidate that figure and to come to cash and I can use it. Automatically, I can use it. So once I know that that cash is available for utilization, can be converted to is utilization of my cash and cash equivalent, yes, I can factor it in, right? But once that cash is not available, which we call restricted cash, right? Or which other name they need to call it again? The other names they call it, I cannot factor it within my cash preparation because it's not available for me to use. Yeah. So in that scenario, it's called what? Restricted cash. So you not see me factor it in my cash flow projection. Okay. So Daniel has a question. Let me unmute Daniel. Hi, Daniel.
Yes. Good evening, Mr. Dele.
Hi,
so, yes, please. Speaking about the restricted cash, what if I know that item, for instance, is going to be free for me, let's say 2 weeks' time or 3 weeks' time? Are you saying that I will not factor it into the cash flow forecast?
Now, you've answered a very vital point. You know that in 2 weeks' time or 3 weeks' time, it will become available. Abi? Meaning that yes, what you need to now do in your cash flow planning is that it is that 2 weeks' time or 3 weeks' time that you make it available for utilization.
Good.
Do you understand? So, provided it still meets that definition of restricted cash, is not available. But if you know there's a time duration when you know it's going to become available, you can plan it in your cash flow projection to make that cash available at that particular point in time. Yeah?
Okay. The second, sorry, please. I was trying to ask about the difference between scenario and sensitivity analysis. Sometimes the bankers will tell you cash flow needs to be sensitized, whereas you have placed scenarios in your cash flow forecast.
Yeah.
Could you speak to this, please?
Yeah. So they are related, but they are not the same, right? At the end of the day, as part of sensitizing your model, use scenarios for it, right? But in order to sensitize it more, is the ability to play around some of the assumptions and stress test the model and see how the model is able to respond to those flexibility in some of the assumptions, right? So you agree with me that your scenarios just picks 3 scenarios. But when you want to sensitize it, you want to sense check it, you say that you want to say, okay, your price is 200 per unit. If I change to 100 naira per unit, what happens? Can I see repay? So at what point do I think that the price needs to fall to that? At that point, the cash projection will not work, right? So when they ask for sensitizing it, typically is they want to be able to see maybe, for example, assumptions that are driving that cash flow projections, so that they can play around those assumptions and see how it impacts the model. Now, scenario is a way to sensitize your model, basically showing three various variables or three scenarios and see how it plays out. But it's not sufficient, right? But that place is left for the user of the model to be able to sensitize it by just being able to play with some of the assumptions around it, right? So, for example, if I lose a particular customer, what happens? If I do 50% of my volume, what happens? If, for example, the naira is devalued, what happens? Do you understand? If interest rates rises from 30% to 35%, what happens? Do you get? Your scenario is limited. You agree with me that there's a limit to how many scenarios you want to do on a financial model. But when you want to sensitize it, there are a lot of things you could potentially play with, because you can play with any of the assumptions and change what the values will look like and see how it all plays out, right? I don't expect that they expect that, oh, you are just basically saying, see, oh, these are the assumptions available for this, my cash flow projection. It's left for them to play around it. They just want to clearly be able to see that the model is linked properly, that they can play with the assumption that drives the model, and they can see the outcome of it on the cash flow projection. I don't know, Daniel, I don't know if I've answered your question. So someone said, does risk analysis describe this sensitization you're explaining? So, like, at the end of the day, it's part of your risk analysis and making you to sensitize the model, right? You're trying to sense check some of the assumptions and see that it makes sense and see how the model is able to go or perform under certain stress tests based on certain assumptions around the model, right? And it's part of their way of assessing the risk, right, of that business and seeing how potentially what could happen in terms of the loan and all that. Hi, Waziri.
Good evening, sir.
Yeah, good evening.
Thank you for your explanation, sir. Sir, I'm also new to cash flow projections, but I have listened to your explanation concerning the cash flow projection. But where I'm a little bit confused is that you said the cash flow projection is based on forecast figures data, while like our cash flow statement, which is found in the financial statement, is based on historical data. Yes, but now you talk about cash at hand and then cash in bank as part of your cash projections. So I'm now asking, is it like you are also making projections of your cash to be at hand and in bank, or you are making use of those that's already in existence?
So at the end of the day, right, you agree with me that even when you are building anything, you will not start from empty, right?
Yes.
If today I'm to build a cash flow projection, there will be a starting point. My starting point is one, my opening cash balance.
Okay.
Yeah. Then what are the activities that could happen on a weekly, on a monthly, on a quarterly basis that result to that my cash balance moving? So what you typically see is, you see the things I mentioned under your cash inflows, right? These are the activities that would happen. The net of these two, of my cash inflow and my cash outflow, result to what I call my net cash movement, right?
Sure.
That net cash movement is added to my opening cash balance to give my closing cash balance for every period, either your weekly, your monthly, your quarterly, your annually, right?
Yeah, sure.
But you see your cash inflow and your cash outflow, they are forecasted numbers, right? Your opening balance will be what is historical. Like when I say historical, in sense of your starting point, what had happened as of day. Yeah?
Yeah.
Have you opened your bank account? Have you opened your bank account that by 12 midnight, the balance was 12 million? And when you wake up in the morning, right, by let's say 1 minute past 12, the turn will turn to 15 million. No, right? The answer is most likely no. So what I'm just saying is that your opening balance of your whatever you close cash forms your opening balance, and that's what you start with when building your cash flow projection. When you open the cash flow projection file, you see it. Yeah.
Okay, so thank you very much. I appreciate it.
Okay. All right. Let's see any. So I'll say it's been a while. I know that when we to do manual account, right? When you're doing manual account in ICANN or ACC, usually talk about cash budget. I'm trying to remember the component of cash budget, but I know they are very alike, right? Because they're both of them are futuristic and they are basically planning cash and seeing how it plays out, right? But I can't remember exactly the full component of your cash budget, but I know there's a lot of similarity. But I can't say for certain if they are the same because it's been a while that I've seen cash budgets. In short, I can tell you that more often than not, cash budget ends after our ICANN or ACA classes, and nobody really talks about cash budget when it comes to actual practice. And what you'll be hearing are more of cash flow projections and all, right? But I don't want to say they're the same because I have never really done that comparison between the two. Okay, someone said they're the same. So the power of insight and making decision. If you see your cash balance dipping in 3 months, you have 3 months to fix it, right? Because at the end of the day, what cash flow does for you is that it helps you be able to make sound decision around liquidity planning, right? If you've done your cash projection and you see a dip, you're able to tell that, oh, there's going to be a problem in 3 months' time. Should I get an overdraft from the bank? Should I cut down on my cost of operations? Should I go structure a transaction with one of my customers that will make them pay me my potential sales in advance if I give them a discount? You can know what, you can just plan around it and plan what you need to do. And that's what the power of cash flow projection does for you. Similarly, also, when you see when you see there's a percent cash surplus, you're having excess cash, you see it's growing. It tells you instantly, and should I invest? Because the reality is that when you have idle cash in your bank account, it generates no income, right? So automatically, when you're seeing your cash balance is growing, what do? You say, let me quickly invest. Let me buy treasury bills. Let me do something, and so that it can generate some level of income for me. We can impact my overall operation of the business, right? Also, it can also tell if I have loans, should I prepay them, right? If there's no penalty for prepayment of a loan, and I'm having built excess cash, let me quickly pay down that loan. Because why? It helps me to do what? Save some finance costs. Because when I repay a loan early, it means that the finance costs that Carlo have accrued from that particular facility will no longer accrue to the tune of the amount I paid down. And it's a form of what? Cost savings for the business. So when you see it, it's able to help you make some level of informed decision on what you should do. Do you get? So that's one of the key powers you see when you build cash flow projections, right? They help you, tell you, make the right insight and say, oh, CEO, what should I do? I can easily pay down a loan. I can invest the excess cash, and that could generate additional income. And you could use this to potentially improve the performance of your business, right? As an accountant, just by looking at your cash flow projection, you can advise the business appropriately, right? And that could result into increase in profitability or saving of cost one way or the other for the business based on just from your insight of cash flow projection. Yeah. Now, I mentioned the fact that you could have what you call a medium tier template structure, right? And I mentioned that there are basically like 3 components. You have like your assumption tab, where you have the key assumption driving the model. You have your calculation tab, where you do the calculations in terms of what happens to your cash inflows and what happens to your cash outflow and the net cash movement. And you have your summary in terms of the final outcome of what your cash balance is and how it is trending over time. And whatever key metrics that the business is interested in tracking on a monthly basis. Yeah. So what are those metrics that the business is interested in? How can we reflect that in the summary chart so that the business itself can make informed decision around it? Yeah. So you see, when you blend all this, you see that it's similar to how you think about your standard financial model. It's just that the only difference now is that this only focuses on cash flow. Similarly, you could actually have a very robust financial model where you have your primary 3 statements, which is a an advanced version of this medium tier model that a business would require. Yeah? Are we together? So I think we've gotten to the end of the theory around the financial model itself, or sorry, the cash flow projection. And this is a point where we now go into the projection itself. Now, we're not building a cash flow projection. We're opening an existing template and we're seeing how it works and how some of the data required fit into that entire model in its sense. Yeah. So where do I have my cash flow projection? I think why wasn't there a webinar? I think I have it under my templates. Open. Yeah. So this is a cash flow projection, right? So the first thing you see is the cover page, right? Just basically tells you, oh, this is a cash flow projection. It has your table of contents, which basically tells you all the sheets I have. It has my cash flow projection. It's built in an hyperlink, right? That comes into this space. Yeah. Then it has your general assumption here. So these are the general assumptions I have in this place. I have my salary, contract staff salary, tax payment, I have them here in terms of what I think those figures will be and when they will be. Yeah. So this is, I'm talking about week 1, and these are the days, the period within that week. Week 2, these are the period within that week, and you can see that all the way. Yeah. So in this particular scenario, I have an 8-week cash flow projection. So it shows me 1, salary, contract staff, tax payment is divided into various tax payments, and I projected it for the next 8 weeks, what it looks like. And I've said that, oh, we'll pay salary in the 3rd week, we'll pay VAT and withholdings in 3rd week around this period, right? And that's what it will be. And you can see it here. I've said, oh, we'll pay all these things within this week, and you can see we're paying salary around this period. Yeah, can you see? Okay. Now, the next thing I'll show you is that in this particular place, what you call your bank balance report. Your bank's balance report is saying, at the point of when you are building the cash flow projection, what are your various bank accounts you own, and what are the bank balances? So in this particular scenario, you're seeing I've listed my bank accounts and the total amount I have in cash for my various bank accounts. You see them broken down, all my bank, and I have my total here. Yeah. Let me see. Stop sharing. Yeah. So you can see it here. Yeah. We have FN, F2, right? You can see it built into here. Yeah. Cash flow projection. So basically the idea is that I'll list all my bank. The balance I'm referring to is what I have in my bank, not my GL balance, right? My bank, what's my bank statement? I'll pick them down. Typically, you see someone pull into it. Yeah. Now, go back to your table of contents. I have a sheet dedicated for sales. I have a sheet dedicated for trade, aging of my trade receivable and payable. I have my loan. All right. In the sales sheet, what you see is I have my breakdown of my customer, right? And you see, I'm saying, oh, for this particular business, they have an average volume of different products, what the product, the volume they do, and the price. And this gives me like an expected cash of how much to be, right? The idea is that whatever I sell in this particular period, for example, maybe it comes in week 4, week 5, and I projected it. Now, but this, like I said, is a function of how you think about your forecasted sales. It could be a case of, you say I did it by product, right? What one could do is build one by customer. And because, you know, at the end of the day, when I sell to a customer, I know the credit term I agree with that customer, right? And I know when the cash flow will come in. So I'll basically be able to do an analysis of what the projected sales will be by a customer. And based on the agreed credit term, I can tell you when those cash will come in, right? And I build that into it. And easily, like I said, you see what I've done here, I can do something similar for on the customer basis just below. Yeah. Now, so whatever I have here, I project it for the period over the period I'm interested in, and I can link this to what? Back to my what? My cash flow projection summary, but we'll come there. The next part is my age receivable and payable. Yeah. What you see in the particular scenario, you see, I have my customer, right? My customer, I have my weekly periods, right? And what you're seeing here is the receivable due based on various months, right? What do I mean by this? Once I've sold to a customer, I'm able to export a receivable report from which I am able to say, oh, when the expected collection will happen. Now, let's put that into context, right? So I have a data here. So this is an example, right? So I have this, let me copy and paste this figure. Yeah, so this is sales figure, right? To various customers. I have them here. You see this particular sales figure, for example. I know I've sold to this customer. I have my credit term agreed with them based on this, right? 30 days, 90 days, 60 days, 15 days, and these are all the payment terms we agreed them. Now, you see that data there? I need to be able to analyze the data in a form that I can now feed into that, my cash flow projection, for example. Now, what do I need? For me to be able to achieve that, one, I need to tell that, oh, I invoice the customer by this date, but when do I expect that cash to come in? I need to build, I call it maybe settlement date, or someone can call it due date, right? Now, for some accounting softwares, these are already available. You can just export it from your account software that can tell you when the amount is due, right? But if, for example, you don't have that, right? This is where your knowledge of Excel is important. One is, I use my VLOOKUP is equal to VLOOKUP, select the customer code, comma, yeah, and pick, highlight, press F4 to, yeah, I need column 3, comma, and I choose false. Yeah. So basically, this one is saying no 0, right? What I now need to now do next is, hold on, let me pause my screen. Hold on. This. Sorry. Select. Yeah. Then I can even add. I can do plus what? My invoice date. Let me check, something seems wrong. No, something is wrong somewhere. Hold on. Yes, it's going to be before B now. Okay, see it here. Tab it here. Okay, so I have it there. So invariably, these dates are like the date I'm expecting those inflows to be. Now, you agree with me that you see those dates here, they are like my settlement dates. Yeah. But unfortunately, if I'm looking at today, for example, today is what? 19th of July, 2024 or 2025, say? Yeah. Meaning that anything that is, for example, anything that falls earlier than this date, is as good as that invoice is already due. Customer should have even paid, right? So if, for example, anything that is less than or equal to this date is automatically like week 1. Do you understand? But what I need to just do is say, I will say this minus what? Minus the due date, right? If I see it negative, it's as good as the invoice is due, right? Right? So this is like, what's called it, age, right? Now, I need my due date, where if I'll use minimum between, or let me use maximum between this and 0, right? And I can have that figure here. So what maximum would do is that to pick the higher of this one and the date 0, right? Yeah. So for example, clearly in this particular scenario, a lot of the invoices are already due. This will not be due until September, and you have some other figures are not due. So I have it, this one. So what this means now is I can easily determine whether it will be due in week 1 or week 2 or week 3 or week 4 or whatever, right? So I can put now week due. Anything that is 0 is as good as week 1. Anything approximately close to 0 or close to 0 is week 1. Do you get? So easy way to handle this is I can do this divided by 7, right? Yeah. Anything that is 0 is if error. So I just use if error to trap that one. Comma 0 to close that scenario, right? I already know that I need to wrap that one around round. And I'll say round up. Yeah. Comma 0. Comma 0. Close it here. Yeah. So I put 1. I put as 1. Yeah. So let me check why this thing is making a mistake. Because it's going to be showing 1. Let me see. This divided by 7. Oh, is anything divided by 0 that goes the other way around, Abby? Okay, good enough. No worries. Okay, at the minimum. Okay, all right, that's fine. No, I know what to do. If I see 0, I'll translate it to 1. So I know that my minimum is anything at least is what, week 1. I'll put marks of any of this figure and week 1, right? Now, I'm going to use formula text, right? I'm not going to bore you with trying to write these formulas and all, but this just basically trying to determine the week it is due, right? So this helps me addresses the week due, and we can do that. So you see that anything that is in 0 is in week 1. So this one can you see is week 7, 16, this is week 3, 21 week 3, 12 week 2, right? This one is week 10, and you can see that all the way, right? So it shows you all the various weeks. So what I need to now do next, I make use of a pivot to now summarize it into their various weeks, right? So I just highlight all the figures here. I'll press Alt NVT and press OK, right? So I can now bring in the vendor or customer name. The week it is due, I'll place it in the column and I'll put the amount in value, right? So you see this? This basically helps me translate the figure into how the various transactions are viewed. Yeah. Once I have this, I can now copy this figure and bring it into this place. You see what I have here, right? The data are not the same data, but I'm just showing you how I potentially have converted all those data into this format and now bring it from that place, right? Or customer sales and bring it here and populate it here. Once I paste the data here, what you will now see is the figure will feed into my total customer pool and will now feed into my cash flow projection, right? But like I said, this requires some level of knowledge in Excel. So you see that one, it covers customer data. Yeah. So you see here, first, I made use of VLOOKUP to be able to determine the settlement date or the date it is going to be due. I determine the age of the invoice by picking. Let me stop. I think this is my speaker that is linked to. Okay. All right. Yeah. So I made use of the dates and compared to get my age. I was able to choose whether ensure that the figures align all figures from 0, right? Because anything that is negative means that it's already past due. Let's not disturb ourselves, right? I got that figure to 0, means that it's due now, right? Then I made use of this. There could have been a simpler approach to determine whether it is due in week 1, week 2, week 3, which we also, right? Once I did that, I now went further by making use of pivots to now summarize it into this format. It listed all the customers and it's basically telling me how each of them, the date they are due. Yeah. So imagine if, for example, let's play with this data a little bit. This is the date here, but let's add this plus round between, let's say 60 to 120. So let's play with this a little. Let's press F4. I'll just drag it down, right? So this way, I've kind of altered the dates a little bit. So you can see week 5 and all. So you saw how the summary was before all of this. So let me just right click and refresh. So you see now it has now kind of distributed a little bit. This is just telling you how the data potentially could alter, right? Based on what the data is feeling like. Yeah. Now, this same concept could also be applied to the vendor side of things. But this is a scenario whereby your accounting software does not have that aging report of your vendor or customer, because sometimes some people, either it's not working correctly or it is not available. So this is how to do it manually outside of your your accounting software. But let's take time and look at the questions that people are saying in the chat box. So for those asking for the recorded version, it's going to be available on the YouTube channel, right? I think I copied the YouTube channel to you people. Yeah, so I copied it. Let me drop it on the chat box and drop it here. So you definitely see all recordings and also the material on the YouTube channel, and you can just follow us and you'll be able to see those things. Yeah. So I said the same thing can be applied when you're dealing with your vendors the same way. The same process would also apply, and we can also do the same thing and you get something similar, right? Which is in the projection here. Now, so this gives you an idea of how we summarize the projection into weekly and into monthly, right? Into weekly. So if our monthly is going to be something similar, right? All we need to do is, based on the age and the period, we can divide by 30 days. We divide by 7 to turn into a week. If it was monthly, we just divide by 30 to say, oh, it's in month 1, month 2, month 3, and that's how it will change. Yeah? And that is where it will vary. The next sheet we'll talk about is the loan sheet. This one is basically just showing a loan and telling that, oh, we have 2 loans, right? When there are multiple loans and we know the period where they will come in. This one, there's no calculation. This is when the loan will come in. You just basically paste in the figures. Typically, you extract this from a loan schedule, right? And say, oh, they're giving a loan and this is when they expect it, or when they expect, you think the loan disbursement will come in. Do you get? So as you're dealing or engaging with the bank, you're already knowing that, oh, I'm a contractor, so the offer letter has been issued, I've agreed, they've signed the contract, I'm doing CPs. CPs are conditions precedent to disbursement. You are fulfilling them, and once they are fully fulfilled, they will disburse. And that's it here, right? Then you also have how you think interest, when the loan is disbursed, how much of interest will come in, and when you intend to pay principal, and you have them in the cash flow projection, right? And you build that again for 8 weeks. Yeah. Now, the next portion is the procurement side of things. So similar to what Doctor mentioned. So you have a list of vendors or products that you intend to buy and their values, right? So you already have, oh, there's a need for certain products, and these are the values. And you have the expectation, because you engage your procurement team, you have an understanding of when those procurement will be needed, right? So you put them exactly at the timing when they said, oh, we'll pay for them. Are we paying the vendor in advance? Are we paying them part payments? And all those understanding will now determine how you now project all those payments, how they flow out. Yeah. Similarly, you could have vendors, right? So you have vendors you are paying, and you know when you're going to pay them. So above, you're looking at it from a product perspective, right? And below, and I said, oh, vendors you are dealing with, maybe they're open POs that you need to pay on, or when you intend you're going to pay them, right? So you're listing all the vendors and the amount, and when you think the payments will happen over the 8-week period. Yeah. Then just at the bottom, you have the sum, right? You have the formula for calculation of the totals of your procurement, which you've listed here, right? Clearly linked based on the sum of what is coming from products and what is coming from, what's call it, vendor payment, right? Then, like I said, for CapEx, you have something similar. The various CapEx, whether truck, new machine, computers, construction of a warehouse, right? You know when those cash flows will happen, you have projected them here, listed them fully, so that at any point in time, if you need those, you know you projected them based on how you think those payments will go out, right? You have them here. Then potentially you could have lease payment, depending on the nature of your business. You can have a lot of lease property. So you want to know, oh, based on how you've leased those property, at what point will those payments come? It may not apply to everybody, but there are scenarios where it could happen here. Now, what have you seen me build so far, right? There are some things that may apply to some businesses that may not apply to some other businesses. It's very important to understand your business use case, right? And based on your business use case, you're able to project what are the various things of inflow, outflow that will happen. Once you know all the various cash flows in terms of inflow and outflow, you can now go back to your cash flow projection, right? Which is the summary. I don't know, I think it was Kadiri, or I can't remember his name, it was Ziwaziri. So you see this 1.8 billion here. If I press Control, open square bracket, you see that it's linking to my cash balance report. Because my cash balance report shows me all my cash available, right? Going to your question, if I had restricted cash, for example, let's say I called figure restricted cash, right? And I know my restricted cash balances. Let's say, for example, this my 377 is restricted cash. It can be a case of, oh, this minus whatever is restricted cash, because I don't want to factor it into my model because that cash is not available for utilization, right? And I have it in my cash flow projection. Yeah. So you see that this figure now changes to what my revised cash balance is. Then on my weekly basis, you will just see me collection from customer. You see this figure? If I press Control, open square bracket, it's picking from where? My trade receivable all the way to week 8. So if you follow the cash flow projection, it follows all the way. Trade receivable and payable. Can you see it? It fits all the way, right? New sales, the same thing. It's feeding from my sales sheet. Control open square bracket, right? You see it's picking all the way. So as there are new sales, it's picking from this sheet and it's feeding into what? My cash flow projection, right? New loan, similarly, again, I have my loan, right? From week 1 to week 8. Can you see? Open square bracket, it's feeding all the way and it's feeding to this sheet. Yeah. Now, you see here, I now have my order payment, similar to vendor payment, Control open square bracket. It's picking from my vendor payment. Let me 628. Yeah, okay. Exactly, 693. Can you see week 1? And all the way is feeding into my cash flow projection. Procurement, same procurement plan. Can you see? It's feeding all the way into my cash flow projection. So you see Then my salary payment and all. It's feeding from my general assumption. My loan repayment feeding from my loan sheet. My capex feeding from my procurement and capex plan. Lease payment is coming from my lease or rent. Tax payment is coming from let me check. Okay, what is control? Okay, so controls open square brackets. So my keyboard, right? There's a symbol known as this. Can you see this? Can you see this symbol? It's what is called open square brackets. So when I want to when I want to reference a cell, I want to go to where it's coming from, right? On my keyboard. I just press Control and square brackets, and it take me to that place, right? So cash flow projection, Control, open square bracket, it takes me to that place. Yeah. So now that when I play on my keyboard, I don't need to start going to that place. It just helps me, takes me to the source data from there. Yeah. So that's what that means. Let me check what else. No, so one I can tell you for free is that everybody will get the material. You can always do, there's no business you cannot do cash flow projection for. Everything is a function of data and understanding of the business, right? In short, it's them, right? Now it's because of them that they created cash flow projection, right? It's because of them they created a cash flow projection. Yeah. So once I've done that, you see that I have my cash balance, right? What you now see is I have my total cash outflow, I have my total cash inflow. Then the difference between the two of them, which is this, is my net cash movement. My opening is what? The previous period's closing, and my closing is the sum of these two, right? And I do that project to my cash flow. Now, you see what I've done here? I've said it's fine. I've written a formula that checks whether my cash has a problem. And whenever there's an issue, it triggers it and gives me conditional formatting. It tells me cash issue at this point. So I know that there's a problem in my week 8. So I have an 8-week. Now that I know, I can plan 8 weeks ahead to plan for that issue. Now, what I've also done in this particular scenario, if you check, I had what you call a minimum cash balance, right? Meaning that, oh, there's a cash, but the business will have what you call a minimum cash balance. Meaning that at every point in time, cash must not be below this particular amount because the business uses that as a form of safeguard that it should always have that figure. So for example, let's say I put 500 million here, for example, now, right? That's my minimum cash balance. If I go to my cash flow projection, yeah, you see that it's throwing it up. Let's even turn that my minimum cash balance is 3 billion. Let's put that 3 billion, 3E9, right? Yeah. Can you see? Because that's my minimum cash balance. See, can you see? Cash problem, cash issue, cash issue. Can you see? Just turn to red to call my attention to it that something is what? Wrong at that point in time. Yeah. So all this in combination helps you properly be able to plan, identify a problem for here. Sorry. So what I have done is a combination of conditional formatting, right, and a formula. So the color coding you're seeing there is conditional formatting, right, and the showing whether it's fine or cash issue is use of if and if statement, right? That would easily just drop and tell you whether there's a problem or not. Yeah. So while we answer questions, I just want to also call our attention to something, right? So just again, also mention, right? We have trainings available for you. We're about to conclude our financial modeling training. We have the Excel of our accountant starting 2nd of August. And so just so you can join, it's also something that you can always, like, I can tell you for a fact that it's very cheap, right? You can join virtually for the Excel for accountant for just 16,125, and you can join physically for 32,250, right? So don't feel shy. Always try to join the training, as we deliver value beyond the expectation, right? Now, if you realize something, I've used a lot of things within that model, right? I've used shortcuts, I use cell referencing. In some places, I use dated function, I use logic and lookup function. A combination of all these functions, knowing them and how you could potentially combine them. So it's one thing to know functionality to apply them. If you look at the model, you see that it's not complex, right? I just use some basic formulas and functions and combine them together. Now, if you want to appreciate some of these stuff, I encourage you to come for an Excel for accounting class, right? The class will help you in terms of being able to build something similar to what I've shown you here in a very simple and clean way, right? That, trust me, whatever models you had for cash progression, when you bring this on board in your office and just show them, and next report, you send it to your management to say, this is the report, and I say, everybody will be wowed and they'll be like, no, I think we need to give guy a pay raise. No, we need to promote this man. He's doing a great job. Let's promote him and let's get him to the next level, right? And that's what this does you, right? That's what this program does for you. Yeah. So you can see the model has been built to clearly show you different things that you can play out, and you can easily. I made it not very cumbersome, right? In terms of the use of functions, it's very easy to use. Yeah. But we could take it to a higher level in terms of how we think about modeling. Mostly the kind of models that are submitted to banks, they typically are a little more complex than what I've done here, right? But the ideology of how they work and the various things to come out to be the same. The other thing is how you just structure it and show how they want. And like I said, from a banking perspective, the key thing you are worried about is how do you service the loan, and how is the loan going to be utilized, right? Are you investing in capex? Are you investing in working capital? And how does that help you generate cash to be able to pay the loan over time? And like I said, the duration of the cash flow projection must at a minimum match the length of the tenure of that facility. And the frequency or the time horizon of the loan should be something that matches the frequency of how the repayment. You are settling every month, the projection should be on a monthly basis. If you are paying every quarterly, at the minimum, it should be on a quarterly basis. If you are paying biannually, minimum should be biannually. If it's annually, at the minimum, should be annually, right? That way, so that the bank can always be able to marry and relate each of them. Yeah. Yes, the opening bank balance is from the bank, right? Jesus, Israel. Okay. Okay, I think their hands raised. Let's listen to them. Okay, Sunday. Hello, Okwe.
Yes, good evening. Good
You are
evening.
speaking, we can't hear you. Abi?
Good evening.
Okay, I think it's from this side. Hold on. Okay, hold on, just hold on. I think it's from our side. All right, okay, you can speak now.
Yeah, thank you. Good evening. Can you hear me now?
Yeah, sure, we can loud and clear.
All right. Thank you very much for the presentation so far. Please, I'm actually new to cash flow, and I would just love to ask a few questions. Like, do you advise a new company, a new startup company, to actually prepare a cash flow report? Like, the company has not even break even and all, they're just starting operation. And do you advise the company to prepare a cash flow report?
My answer is a very strong yes. Because that kind of business that is not even making profits, it means that if you're not tracking your cash, right, at some point you run out of cash and the business will not be able to operate again. So you want to that part of it, liquidity planning should be a priority for them, right? And you want to generate cash flow and be monitoring your cash. It's very important.
Okay, thank you very much.
No, you should be able to see my full screen. Can't Lawrence confirm? I think is anybody can see my full screen again? Is the cash flow projection for 8 weeks similar to cash budget? I don't know if I'm correct. So then you know that like I said, cash budget was a thing during ICANN class to talk about. I don't know if anybody from a practical somebody to talk about cash budget again, right? But like I said, if you follow the theory of when we're explaining it, when you see 8 week, you know that that's a very robust and you're trying to track liquidity well, right? And that's the goal. Not from a budgeting standpoint, but more of liquidity planning and tracking and ensuring that, oh, you don't want to get into trouble. Yeah, so right now I did not include a summary page, right? But we can include a summary page and just to make it more interesting, right? All I just did was the cash flow projection, which is like the final output of the model itself, right? We can include a summary page that just includes some key highlights that we want to pay close attention to, but that can be included on the template itself. So someone said, for our virtual classes, are they real time or online? They are real time, right? You can join, right? There are specific days, Saturdays and Sundays between 10 a.m. to 3 p.m. on Saturdays, and on Sundays, 1 p.m. to 4 p.m. So they are real time. I'm trying to look for the link. Let me see if I can get the link for you. So let me get the link for the Excel class so that you can have it. Does the yeah, so I can drop it in the chat box. So it's in Lagos, physical location is 2/5 Do Ajao Street, Ajao Estate, Anthony, Lagos. Okay, so we'll give one more questions. So someone said something. Hey, I'm missing out something. So someone said, trying to get the question correctly. In your cash flow projection, do you put your customer's credit balance from advance payments into your consideration? Now the question is, one, at the end there is cash, right? Your customer credit balance in cash is that you have already collected the cash, right? So invariably it doesn't affect your cash projection. The only problem you have is that if that kind of person buys a good, it's not translated into cash because he has already paid in advance. So you want to be careful about ensuring that how much of your cash or your future sales is going to be offset by your collections or your advance payment you receive in advance, right? You want to be careful not to count them as cash inflow again. Otherwise, you'll be double counting it because that kind of customer is not going to pay you again new and fresh. So you want to be careful about such. How do you turn minimum cash balance? The minimum cash balance is actually the amount you as a business decide that at the minimum you want to hold. Somebody will tell you that it may be salary for 3 months. At the minimum, that cash balance will be there. Or they have an idea, or they say, oh, we know as a business, our working capital need on a monthly basis is 200 million, right? Per month. They now say they want to have 3 months working capital cash balance, right? So it can be 600. So it's a function of your understanding of the business and what you say your cash need at the minimum is and what you want to say at the threshold as a minimum cash balance at any point in time. Because once you hit that cash balance, you know that it's a trigger warning that something wants to happen and you need to be careful about it. Yeah, so Tunde and Tai will answer your question. So for don't ask me for the material will be available on the YouTube channel, right? Once we are done, we upload the video, both the templates and the presentation we upload in to be available on the YouTube channel. Something, how do you join Accounting Yard platform, right? So you can, on whatever group you are on, we'll just send it and you can always join us, right? There's a number you can chat with. Let me share the Accounting Yard official number and you can always chat that number at any point in time. So Yard. So let me see. Where's the number? Yep. So this is the official Accounting Yard number. So you can always reach out at every point in time, anyone. Yeah. So let's just hear what people have to say. There are a lot of people that have their hands up. So let's hear what they have to say.
Hello, sir.
Yeah.
Well done, sir. Seriously, we enjoyed the webinar, but I look at it as just a taste. And I would like a solution whereby you program it together with your other programs so that we can consider each of those complex area in the cash flow projections. So that is my first advice. The second one, I've forgotten. I know we have to, but I forgot the second one. Thank you.
No problem. No problem. All right, that's fine. Hi, Miriam.
Okay, good evening.
Yeah, good evening.
Can you hear me?
Yeah, I can hear you.
Okay, my initial question was based on the minimum cash balance. Well, I understand your explanation right now, but my question is, can your restricted cash form part of your minimum cash balance?
Can it form part of it? So I'll say no, right? In the sense that because when you say you restricted cash, it means that it's not available for use, right? So if you are using the plan, if you fall into a problem and your restricted cash is now your minimum cash balance, you can't use it.
Mm-hmm.
Yeah, you
Okay.
can't. What was
Yeah.
your first question again? I don't think, did I get the first one?
No, the first one was what was the determinant of your minimum cash balance, but someone already asked that, and I understood your explanation on that. So it now brought me to the second question of if your restricted cash balance can be your minimum cash.
So no, right? It cannot be because
Okay.
if there's an issue with the business, you cannot utilize your restricted cash. So if you plan with it,
Okay.
you just become, it's going to be a problem for you.
All right. Thank you very much.
No problem. Hi, Isaka.
Hi. I think my question is quite similar to a question Dari asked. Is AI advanced enough to reliably help preparation in tracking cash flow projection? So the question is for your bank balances now. Can the sheet be automated in a sense where as the week passes, then the bank balances automatically changes?
So I say this, can the sheet be automated that way to handle that piece? That you are saying?
Yes. Mm-hmm.
So my answer would be, to the best of my knowledge, I would say no, right? And the sense why I say so is that if except there is a means in which you have a way to integrate your banking platform to Google spreadsheet, which I doubt is the case, right? So from that perspective, I would say no. Do you get?
Okay. All right.
Yeah, from that part, I know that globally, right? Their applications, the banks globally have a way whereby they've linked their bank accounts, right, or their banking applications to their accounting softwares, so that
Yeah,
at a
similar.
time
Yeah.
basis you can get it. In Nigeria, that has not really happened, but I know that I think either Money Point or Wema has something similar. I've seen something similar. I've seen it only in one place, right? So if they could get to that level, potentially they could find a way to link it to a spreadsheet that would automate that process, right? So that's why I think that it may be possible, but for my experience so far, I've not seen it yet.
All right. Thank you.
Now, from an AI point of view, I've seen AI do a lot of things, right? And I think that this cash flow projection is something potentially it may potentially be able to do, right? Because at the end of the day, a good portion of the data it can feed from systems. And if, for example, those systems are configured to be able to pull out some of those report or data, it can be able to project it. Now, there is a particular AI called Cloudy, Claude, and that particular application is able to help you do programming, right? And I've seen it do some element of programming to build some level of spreadsheet, right? So from that perspective, if once you have someone who has a good knowledge of how Cloudy works, and that Cloudy can generate Python codes, then that code can be used to generate Excel spreadsheets that can do cash flow projection, right? It's just a question of expertise and knowledge combination that will help you be able to do that, right? There may be some element of learnings, but from that perspective, yes, it's possible. Mohammed Omuya.
Okay, good evening.
Yeah, good evening, Mohammed.
I just want to know, I think I missed out on the webinar. I missed out some things. So, can we download it from the YouTube?
Yeah, sure. So everything will be available on the YouTube channel. So take the opportunity to take up everything you have from the YouTube channel.
Okay, okay. And secondly, this accounting yard Telegram. So I've been unable to join. Maybe ever since I've joined accounting yard, I've been getting lecture from here. So I don't know. How can we join?
Yeah, so I can tell you that the Telegram group has been shut down, but there's a WhatsApp
Okay.
group, right? There's not a WhatsApp group called KSG. So if you want to join, just let me know. Just chat me and I'll send you the WhatsApp link to join.
Okay. So for the YouTube now, are you sending us the link that will take us to the YouTube, or we should just go to the YouTube channel and get it there?
So let me send it. I've sent it before, but let me send it again, right? So if you subscribe, you get notified once once it's loaded. Yeah.
Okay. Okay. No problem.
Let me see.
Thank you.
I'm dropping it in the chat box.
Okay. Thank you.
Yeah. So at the end of the day, everything, the presentation, that's the slide, and these worksheets will be uploaded to the YouTube channel. Yeah. Hi, Olariwaju.
Yeah, thank you very much, Prof, for every explanation you've given so far. Yeah, so my question is concerning, working in an organization that is the business is struggling, where most there are times when you need to pay for some expenses, and it is the directors, either the CEO or like one of the directors that had to loan the business money to pay for those expenses. In a situation like that, and you see that it is something that would continue, maybe probably in the next 8 months to the next 15 months, and you're trying to build a cash flow projection for the next 6 months. How do you factor that into your projection? Because this is something that is futuristic.
Yeah, I get you. The honest truth is that at the end, the director is one of the shareholders of the business, right? Yeah, Olarinwaju. I don't know. I can't hear you. I don't know if you muted yourself. So let me try to unmute you. Oh, Olarinwaju, I cannot hear you again. But in actual sense, you can't really plan that in your cash flow, right? You just know that there's a huge cash flow shortfall, and you can clearly communicate that this is a cash flow shortfall. Now, so it's just a case of you need to communicate and say, see, this was happening. And you need to just understand how bad is it, right? And is it something that the person can willing to be support? Clearly, it depends on doing it. The person is most likely seeing the business and supporting the business, and he believes in the business, right? And is willing to support the business. So that's why you're seeing it. But from a cash flow point of view, you cannot really put it. You only just know that there's a problem, and the person is always willing to step in to support. Do you get? To a large extent? You can't really plan it because it's not something within your control. It's only him that can decide whether he wants to put or not. Except he clearly points to you that tells you that, oh, when the amount is within this range, I will support, right? And you can put as an inflow in terms of, like, let's say, loan from shareholder or loan from director. Do you get? But he is just stepping in. You cannot say what it is, but if you've had a formal conversation with him and he has told you that whenever there's a cash flow, you put it in and it gives you a range of what the amount to be, then in potential you can put in your cash inflow and say loan from director, right? In the interim. But that's the easiest or the best way I can think about you placing that in the model. Hi, Oluwaseun. Hi, Oluwaseun.
Yeah, good afternoon.
Yeah,
Good evening, rather.
good evening. Yeah.
Thank you for the session. It's really enjoyable. I have two questions. The first question is when you started and about we're talking about the courses for this month, for this year. You said they are not going to be repeated. Does that mean that next year you're not going to have these courses as well?
Yeah, so what I mean,
That's number one.
okay, continue.
That's number one. The secondly, the cash flow statement for each week. Does it mean that when I know that at some point there will be variance based on what you have in your account and what has been projected in a way where you want it to be exactly to be the same thing in what is in your bank account? How do you go about that? The way that you will go back and change some figures, and I know that that will be based on historical data now. Do you understand what I'm saying? The second question is
Okay. So if I get what you're saying, right? So
the second question. Yes.
so question two. Now, the way the
Yes.
calculation works is that I prepare it once in a week, right? So
Okay.
on Monday, when I resume at work, I get my bank balance and put my and prepare it. I don't modify it during the course of that week, right?
Okay.
When I go to next week, when I resume on Monday again, I prepare another one for another 8 weeks again.
Okay.
So every
Okay.
week, I actually prepare it every week. So it's not like I'm going
Okay.
to alter the numbers to reflect reality. No, I will prepare it afresh, right?
Okay.
For the next 8 weeks.
So that means there will be variances, right?
Yeah,
Between what?
there'll be variances. But the critical thing is that when you see those variances, does it require you to quickly make some adjustment to how you think about things? It will
Okay.
happen. Because the reality is that it's a projection, right? Nobody knows for certain what will happen in the near future, right?
Yes.
If
Yes.
if you are working in a manufacturing company and the plant has an explosion, right? And you need to make a major repair to ensure that the business continue operating. It's not your capital projection that will make you now say you're not going to do it now, right?
Yes. Yeah.
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 And so there will always be some like differences, but the idea is that this would tell you, oh, is there a problem? And how, if I deviate from it, how does it impact the entire liquidity planning or my plan for the next future weeks? Do you understand?
Okay.
Yeah.
Okay. Then number one, it didn't.
Yeah. So the training, what I mean that it's not going to be repeated in the sense that more often than not, most of our trainings happen only once in the course of a year. But by next year, they will be repeated again. However, all the trainings we've done, there's a recording for it. And you can buy the recorded version of the trainings. So if you need recorded training, you can easily just charge the accounting yard number and you can pay for those recorded trainings, right? The only training that we are considering having a repeat for it is financial modeling. But we've not decided at what point we want to have a repeat, right? Because
for this year.
For this year. That's the only training we are considering potentially repeating this year, right? But we've not decided yet, right? Because the reality is that we are limited by time, right? So the only time we have the opportunity to train is a function of time. Look at the calendar very well. You see that almost every month.
It's only September that is open.
Exactly. So maybe in September we'll have a training that will fit into September and all that, right?
Okay.
That's what we're looking for. All right. So there's a limit to the number of questions I can still answer because it's already almost 6:30. So let's just be fast.
Yeah. Okay. Thank you, sir. Quick one. What I wanted to say the other time is that you said the summary is not included in this on this sheet. Okay. Maybe before you said it to us, help us add the summary so that we have access to it. That's what I wanted to add.
Yeah.
Then thank you.
So my fear is that if I promise to include the summary, I may delay in sending out the templates. So what I'll do is I will send the templates as it is, and I would update it at some point to include the summary, so that at least I meet up the requirement of sharing it. Then once I modify to enhance it, you will get it to include summary. So Stephen.
Thank you, sir.
Hi, Stephen and Emmanuel. Hello? Emmanuel, Stephen.
Hello, good afternoon, Ladile.
Yeah, hi, Emmanuel.
First apology, I missed today's class. I had a previous engagement. Thank you for this webinar, very nice. But my challenge has always been the application of formulas. So I want to ask, this Excel training that is coming up, I want to know whether you are going to pay detailed attention to how we apply formulas. Why are we applying it? How do we know which formula to use? Because I observed today that you use lookup formula. I mean, you never apply that. During the financial modeling. So I want to know if you are doing that Excel training, that you pay attention to that. Reason why, to know which exact formula we're supposed to apply. Then the last thing I just want to say is, can you share this through the way you share the financial modeling to some of us that are already on board on accounts, instead of pasting it on YouTube? Can you share it with us using that same way?
No problem, that's fine. So I've heard it, right. So the Excel class, because an Excel class, so there'll be a lot of focus around the application and use of functions, right? So the idea is roughly going to happen for roughly about 8 days. So there'll be 4 days of understanding how functions work. Then there'll be 4 days of how you apply those functions to various use cases, right? So you see clear examples of, how do I apply this function? Where can I use the function and all? Do you get? So that you can strike a balance, right? But your feedback is well noted, and we'll pay attention to ensuring that the application of how we think about applying functions and formulas is well paid attention to during the course of the training.
Thank you.
Yeah. Stephen, I am. Okay, I can't hear anything from Stephen. So I think for the last person, which will be Christian, let's hear from Christian.
All right, good evening, sir. Thank you very much for all that you're doing. I really appreciate. Although my attention is a little bit divided, I'm struggling holding the phone because we've been we've been learning since morning of financial modeling. So like I've not eaten, I've not taken my bed. So I tried to like struggle to arrange myself, and then so I was like holding it from bed. Somehow I got to on one thing that struck me is like you said that this cash flow projection is not historic, like you said. Like the one that we used to prepare in financial statement, that one is historic because it's events that have come and gone, and you're trying to report them per a preceding year. So they're like this now. So this one that you want to use it for future purpose. I wanted to know, please. I just got to see it now. Where did you now get all these your items from? Where did you get your like inflow and outflow items from?
So
You assume them or
yeah, there's some level of assumption, right? So if you notice during the course, I mentioned the fact that you interact with sales, procurement team, right? Your understanding of the business, production team is all those people you are interacting with that you now collect all the data required, right? Collecting data is a very important piece. So typically what people usually do is that they design a template for various people they need data from, and they'll request the data from those people and they'll now bring it into the model itself. But you need to sensitize and check that those data collected are reasonable, right? The example I gave was you have a sales team, they'll tell you 40,000 units. Historically, you've done 20,000 units. They're not going to do 40,000 units. You need to understand how they thought about the 40,000 and what gives them the assurance that 40,000 will be sold. Do you get? So there's a lot of data gathering from the various stakeholders, right?
okay, please, like you cited out, you said that that this cash flow projection is meant for all businesses, even if it's a small one or a big one. One can actually use it to project and see how the cash flows. So what I'm saying now, in a situation where the business is a very small business and it's hard for them to arrange financials, as in data, they don't know how to put data together. Is the person, is the accountant going to now? He's not the person running the business now. So like they buy the inventories, they just do like back of counter transactions. They don't have good bookkeeping records. So how do you manage such situation in projecting their cash flow?
So first, what I would generally suggest is first solve your problem around record keeping and reporting first before you now go into projections, right? Because there's some correlation between the two of them. Because when you don't proper reporting, it gives you a lot of clarity into how to now think about the future. Do you get? So the first step is clear and ensure your reporting is good and they're able to understand how to report. Then move to planning. Do you understand? So you need to first clear that first side. Yeah, it's very important. It doesn't mean that you cannot still do projection while the data is dead to you, but it will be more problematic. And sometimes, because you don't understand historical very well, your projection may be having problems because you don't understand what has happened historically. Do you get? So the first point to be find a way to get reporting good, right? Clearing backlog and cleaning up that backlog around reporting before you now move on to the forecasting side of things.
Okay, like I'm looking at since this project is a projection, it looks like a model. It looks like something that seems. Of course, we have said that some of the items might actually be on assumptions, but then you should have a good knowledge of how the business is a little bit or the people around there. So I'm saying that perhaps you just can someone now look at a business, you have like maybe 60 or 65% average knowledge of how the business can flow, irrespective of how their data mismanagement or underdevelopment. But you can't just look at a business and then with that, the sense of 65% knowledge of the business, use it to prepare a cash flow projection for such a business for it to work like that and issue it as a solution to the business. Is it not possible like that?
So when you said yes, you can. If you understand the business to reasonable extent, you can do cash flow projection and all. But when you say as a solution to the business, I say that it replaces your regular reporting of historical numbers because they are not doing the same thing, right? You can use it for planning, liquidity planning and all, but it does not replace historical reporting.
Okay.
It does not. They are two different things. They don't address the same thing.
Yeah, okay. Thank you, sir.
Okay, the last but not the least is Olalekan. Hi, Olalekan.
Hi, good afternoon, sir.
Yeah, good afternoon.
Yeah, I only wanted to find out. I'm not really a dullard, but I really want to confirm. Do you think it would be nice for someone to enroll for financial modeling who is not really skilled in Excel? Do you advise the person go for the Excel training first before enrolling for the financial modeling?
I would advise you go to Excel training first before you go for financial modeling training. It will help you to simplify your life before you go to financial modeling. Yeah. It's not like you cannot do financial modeling, but it just make all things easier for you when you're going to financial modeling. Okay. So I would just say generally, I think we are done with the webinar. I'm copying the YouTube channel again for those who may have missed out. I shared the link for the Excel class. Where did I copy the Excel class? Yeah. So I think I copied this is the Excel class link, and I dropped it in the chat box for those who are interested. You can use the link to pay to join. Yeah. So thanks everyone. It was an honor taking the webinar, and thanks a lot for all your contribution and your questions. It was quite insightful. I learned one or two from you, and I'm also be able to take the feedback you provided during the course of the webinar in our future. Looking forward to you to join our trainings and join our community. Join either our groups, following us on our various social media platforms, and just be able to be available to make that impact, right? And trust me, we are very good at something, which is delivering value. And I hope that we'll be able to meet your expectation at a minimum from this webinar. I'm looking forward to see you all join our various other trainings and all. Yeah. Take care, everyone, and do enjoy the rest of your weekend and have a pleasant interest. Take care. Bye-bye.